Hi, and welcome to your weekly macro roundup. We talk macro, trying to make sense of markets that, I don't know, they don't really make any sense. But more importantly, answer your questions so we can become better investors. I'm your host, Steven Van Metre, and thank you for joining me today. Have I got an amazing show lined up for you today. In addition to our normal Friday macro stuff that we do, you're going to get a masterclass in one of my favorite macro indicators. You want to take a guess what it is? Do you think you got it? Do you think you know? Did you pick treasury yields? How about treasury bonds? Did you pick that? No and no. I know you're what? I thought you loved treasuries. I do. But one of my favorite macro indicators is import and export data. And we've got it. And man, am I. Oh boy. Wait till we get to that. Let's just jump right into the data from this week. Because if you could see across the top, and I know my friend Chris Dark is getting excited. You want charts? I got charts, but we got to get through the other stuff first. Let's head back to Wednesday post-market close and see what we found in the data that's of interest to me. And nothing really interesting Wednesday. Moving into Thursday. We've got CPI out of Switzerland still negative at 1.3%. I thought there was something. Oh, here, CPI, South Korea Wednesday night in June flat. So no change, no inflation, no deflation, which is an improvement from minus 0.3% the month before. Still not enough to change any opinions, but if you're looking for some potential trend change, that may be a spark. Maybe. I doubt it, but it could be. How about producer prices coming out of the factory in the Eurozone on a year-over-year basis, down 5% from minus 4.5% the month before. So this is absolutely deflationary coming out of the factories in the Eurozone. Now let's move into the U.S. data for Thursday. And I just need to be upfront with you. I'm not really going over the non-farm payroll report. As far as I'm concerned, it is completely out of line. It is so bad that I'll talk about the data momentarily, but it's not worth going over. And I'll tell you why. And this is kind of interesting that, again, not picking on anybody in particular here, but then Donald Trump tweeted ahead of Obama's reelection after his first term, or at the end of his first term, that the BLS, Bureau of Labor Statistics, was manipulating the non-farm payroll report to help him get reelected. Well, Mr. President, if you thought what they were doing then was bad, what they're doing for you is far worse. I mean, they're really, the data is so bad, it's not even funny. But the way the BLS can get away with this is probably in a year to year and a half from now, they'll have a revision and be like, oh, hey, well, yeah, it was pretty bad. And how did we got that wrong? I'm sure there's some sort of data reporting errors or whatnot. It's not even close to real. So let's go into the data from Thursday. And let's start with the non-farm payroll report. Came in at plus 4.8 million jobs. Now, it doesn't mean these are brand new jobs created. These could be people that are just going back to their old jobs. Consensus was 3 million jobs. The reality is this number is totally bogus. If we look at average hourly earnings on a month-over-month basis, they slip from minus 1% to minus 1.2%. So wages are slipping a little bit. On a year-over-year basis, hourly earnings are slowing down to 5%. And weekly hours worked also slowed from 34.7 to 34.5. You said, well, that's not a big difference. Well, it's quite a bit. 0.2 is, a lot. It doesn't seem like a lot, but in terms of adding up all the payrolls, it's a decent amount. Let's take a look at and then we had the participation rate. Edged higher to 61.5. Of course, then the BLS did admit that this number is probably wrong, but I'll go ahead and suggest that all of the numbers they release in that report are probably wrong. With that, the U6 unemployment rate slowed to 18%, and the broad unemployment rate that you'll hear in the news is slowed from 13.3 to 11.0. 1%. Let's get into the jobless claim data. A lot more accuracy here because these are actual claims that people are filing. So last week, 1.427 million Americans filed initial jobless claims, down slightly from the week before, but this number is very high. I mean, normally when you're seeing the end of a recession, this number should be dropping. And it's just sitting right near this 1.4 to 1.5 million per week. This is not good. The 4-week moving average for claims is hovering right around 1.5 million, slowed from 1.6 the week before. And continuing jobless claims is static at 19.3 million. Now, the real number, because one thing that some people have gotten confused about when they watch this and they look at this number and they're going to hear what I'm about to say, is this number does not include all forms of jobless benefits. It doesn't. The actual number went from 30.5 million to 31.5 million Americans actually are receiving some form of jobless benefit. That is not good. That tells you right there, if you were like, man, there's got to be a recovery. Not when there's 31.5 million Americans receiving an unemployment benefit of some form or another. So just so you know, when you look at this number, it does not include a lot of other things, but even if it did, it's still static at where it was. But the real number, 31.5 million, you're welcome to fact check that anywhere you like. It is the real deal. How about import and export? Now, we're going to get into this in a deeper way, but I just want to look at the numbers, and we'll get to all of this a little bit later. I want to build some anticipation of the excitement of what you can learn from the import and export data. Exports fell from 151 billion to 144.5 billion, not good. Imports, much better number, fell from almost 201 billion to 199 billion. So much better on the import side than the export. And let's see what else we have here. Car sales and truck sales. Now look at this. Car sales went up from 2.73 million to 2.97 million. You say, wow, that's really great. And there's a recovery. Well, let's look at a chart or graph, and we'll zoom it out, and you can see that it went from the toilet to slightly above that. And over a 5-year period, it's at the lowest level. This thing is terrible. You're typically seeing car sales in an expansion. You know, remember, the number here is, say 3 million. Normally, car sales are around mid 7 million. Not good. So there was a recovery, but not a big one. How about all truck sales? Hovering around 10 million. And let's take a look. Is that a big recovery or not? Well, no, because truck sales were just over 12 million before. They're typically running around, and the last expansion got up to about 9.5 million. The truck sales have been hot in this last expansion, but we're 2 million a month off where it needs to be, and that number needs to continue to rise. So improvement on truck sales, but not as much as we need to see. Let's see, ISM New York business conditions. I really didn't look at this data last week or yesterday. Yeah, I guess it would, no. Yep, yesterday. Didn't really look at that, so I don't have any comment on that. Factory orders on a month-over-month basis went from minus 13.5 to plus 8. Again, this is month-over-month data, so it's an 8% increase from last month's low. Excluding transportation, they only rose 2.6% on a month-over-month basis. And durable goods new orders, excluding defense, were revised from 15.5 to 15.3% in May, so slight decrease there. Not a major deal. The numbers are so close it doesn't matter. Let's move on to Australia, which came out as services PMI, showed a slight expansion over an absolute cratering of the month before to 26.9 the month before. So we see a slight expansion from last month. So what it says, the services sector in Australia got slightly better from horrible. I mean, from just absolute disaster. It just slightly improved. How about the services PMI in Japan? Well, it was, if you think Australia's data is bad, take a look at Japan at 26.5 last month. It further contracted again, slight contraction, the print at 45. Japan is just in bad shape. If anyone's watching from Japan and can provide any insight to what's going on there, I'd love to hear your opinion. Please send me a note. Out of China, the cakes and services if I may be saying that wrong. PMI showed a rebound there. The hard data out of China doesn't suggest this number is real, but keep in mind the services index went down to 26.5 and then has slowly inched its way higher. So it does not mean that the services index is all back to normal, but people reporting on this said the hard data does not match. It is China after all. Let's move into Friday and just see what we have going on there. And let's look at the PMIs, just kind of going down the list. Spain, flat. South Africa, contraction. Italy, slight contraction. And composites. Italy services, slight contraction from the month before. French composite, slight expansion. French services, flat. German composite, slight contraction. German services, slight contraction. Broad Eurozone from the market composite, slight contraction, almost no change. Services out of Europe, again, slight contraction. No improvement out of the European economy at all. How about Great Britain composite and services PMI, slight contractions after these economies just imploded. I mean, it's amazing the United States did not come out worse, but that could change here pretty soon. So nothing in the services data or in the services PMI or composite PMIs in June suggesting any form of recovery. Now let's take a look at the assets and liabilities of all commercial banks. This is where we get into the credit data. The credit data here is so important because this is where we're going to start to see a recovery if we see one. Well, how about securities and bank credit? Well, they purchased, it looks like, $34 billion in various mortgage-backed and treasury securities, with mortgage-backed, let's see, make sure we're on the right line, increasing, it looks like about $5 billion. And again, everyone's saying the treasury securities are dead. Well, no, this increased by, looks like $30 billion week ending June 24th. So the large commercial banks continue to support the bond market on top of the Fed. Again, you want to know who the smart money is? It's large commercial banks. When they're buying bonds, Fed's buying bonds, maybe you ought to think about it. How about other securities? No real change there. Loans and leases at all commercial banks, big drop there. Looks like, what, about $54 billion decline there. How about real estate loans? Flat. Maybe a positive sign from the real estate market. I mean, this is critical. The real estate market is super critical. Commercial industrial loans, commercial real estate, that flat. Where's commercial industrial loans? Up here, they had a big decline of, it looks like, around $36 billion. How about consumers? Hey, $2 billion increase. That's a big change for recently. Not big in terms of a huge increase, but it shows perhaps a flattening of consumers paying down their debt. But it also says they're not taking on a lot of new debt. So credit cards increased $1 billion. It looks like other loans increased a little bit, with car loans increasing $1 billion. Now my son, who does work at a car dealer, did say that relatively to the other dealerships in town, they had a blowout month. And we just had his mom's car service there, and we had to go pick it up this morning. Kind of convenient, have the kid pick it up and we can go get it later. I've never seen, this is a Porsche, Audi, Volkswagen dealership, all in one footprint. I mean, it was like I could have parked anywhere I wanted. They had no inventory. So he said they were clearing out the last 2 months, and sure enough, they did. Although I don't think he did $1 billion worth of car loans. I'm sure he would have loved to. But overall, as an industry, the improvements did not translate into a lot of new debt generated. Let's take a look at the balance sheet of the Fed and what's going on with it. Actually, you know what? Let's come back to that. Let's hit the PowerPoints and we'll get to what's going on with the Fed. First off, the M2 money supply 12-month rate of change continues to inch higher. The 6-month rate of change is rising and the 3-month rate of change is falling at 10.6%. What is going on in the money supply? Well, as you can guess, somewhere in here, we've got it. And it really wasn't due to increase in institutional money funds. It wasn't due to an increase in savings deposits. This is very interesting. It was due to an increase in currency. So there looks like there's an increase, about $7 billion demand for currency. So I don't know, are people going to the bank and withdrawing cash? I guess I don't know. I'm not hearing anything about that in the news. But demand deposit. So what is the demand deposit? This is checking accounts, effectively. Because, if you think about what a demand deposit is mean I can walk in and say, hey, I demand that you give me this now. So that would be any form of account that I can get my money out of immediately. So it would not be a time deposit, such as, say, a certificate of deposit. And look at the amount of money just flowing in to demand increased over $100 billion. So money is flowing in there. This could be due to the fact that this would be from the end of last, period 6. So I was 622. So I'm thinking, would this have to do with any government transfer checks or Social Security? No, that should be in the next week's data. So clearly people are saving, and that is a big indicator of potentially what is to come. All right, back to the PowerPoint. And let's see what's going on with the monetary base. Has slid down to 4.866 trillion. So what's going on with the monetary base? Why is it falling? The Fed is easing. Steve, what's going on here? Well, what's happening is we're seeing a roll-off of some mortgage-backed securities. Wait a minute, I thought the Fed was buying those things. They are. But what's happening is the repo loans are coming off their balance sheet. And I think I've got a chart of repo, and you can see that repo is coming down. So as repo matures, the collateral comes back off the Fed's balance sheet, and they did take in a lot of mortgage-backed securities as collateral. The other pieces of interest in here is we see a decline here, 49, almost $50 billion in central bank liquidity swaps. So clearly some of these liquidity or these currency swaps are being paid off or paid back. And then there's a question of how many corporate bonds is the Fed buying a week? About 300 million a day of various corporate and bonds in the form of direct purchases of bonds and ETFs. We do not know how it's split, but it's about 300 billion a day. All right, back to this. So because the monetary base is down slightly, that pulls a money multiplier up. Does this mean all of a sudden there's inflation pulse coming? No, I don't think so, because these liquidity swaps are effectively coming off and these repo loans are coming off, but the Fed's not quitting the QE. I mean, they're going to make that back up in the months to come, if not sooner, because the symptoms of the global problem of the economy just being in the toilet globally is not getting better. So just the fact that some of the stuff's getting paid off or paid back could mean that, foreign central banks are getting some cash from the sale of their treasury securities. We don't have that data because it doesn't come out. It's always lagged. So we'll see how that's going to look soon enough. But for the moment, it just says the Fed balance sheet is falling, but it's not a major deal because, again, once they figure out they have to turn the QE engine up again, that will be restored. So not a major deal, but if you wanted to look at potential inflation pulse, this would get it. We'll see where, and you got to think, where's all that cash that's being saved going? Where's it eventually going to go? Because if this time, in about 3 weeks, the last of the $600 checks are out. So that means if you're on an unemployment benefit, your income is now lower than it was before. And remember what I said is people are going to probably start saving up cash as they're afraid their jobs are not coming back. Well, that's what the M2 is telling us. So is it inflationary? Well, the M2 is rising faster than monetary base, Steve. The Money Multiplier says that you said that that's inflationary. Yeah, I know. But the question always comes down to maybe. It depends. Where is the money and the savings going? Is it going to go to pay for bills and living expenses, or is it going to go to spend on discretionary goods like cars and electronics and all that? If it's being saved to get people by, not inflationary. Not. But remember, I said I thought we'd see a buildup in cash. There you're seeing it. How about real estate loans? Now, the data got revised a little bit, which it does. It's kind of normal. The 12-month growth rate is up 3.87%, so up slightly, but the 6-month rate change is falling at 1.17, and the 3-month rate change, which was negative, got slightly revised higher, is now at 0.01%. So that is headed lower. Commercial industrial loans are down on a 12-month basis to 22.2%. 6-month rate of change is the same point and falling. The 3-month rate of change is 2.23%. So on a 3-month rate of change, this thing is almost back to where it was 3 months ago. So that's not good. This is going to start contracting. Loans and leases at all commercial banks, growth rate is down to 8.04%. 6-month rate of change is 5.03 and falling. Remember, the 3-month rate of change is leads. It's negative at negative 0.83%. Lending is starting to flatline and contract. Not good. How about consumer credit card loans? When we looked at the data, showed a small increase, but on a year-over-year basis, down 7.54%. Is this a pause in the longer term headed down? I believe so that it is. All right, let's get that lined up for later. All right, now into the masterclass of import and exports. Now, why do I like import and export data so much? You can't fake it. It doesn't get revised. It gets minor revisions. It's not seasonally adjusted. It's not, manipulated by, the BLS or any other sources. It is what it is. Whatever came in, whatever went out, it gets tracked. Obviously, there's some minor issues that get cleaned up the month after. It's the real deal. So let's think about this as we're going to flip over and look at the data. So where am I getting this? I'm getting this from the Federal Reserve database. This is as of April. They don't have the most recent one in here. I don't know why they don't have it. It's already posted, but hopefully they'll get it on here soon enough and we can come back to this. So why does this matter? All right, so let's talk about exports for a minute. Do you know what our major export is? Do you know what our number one export is? Airplanes, Boeing. And what else do we export? Crude oil. And we also export agricultural commodities. Those are kind of our big things. So think about, let's really, I want to get you thinking here. So when U.S. exports rise, what does that tell you about the foreign economy? It tells you there's some demand, right? If they're starting to buy airplanes, food, and oil, what does that tell you? Their economies are recovering. And in the cycle, as like say China on one China on one end as the largest export and U.S. on the largest import, what does it tell you for an economic recovery? Well, the economic recovery starts in Asia because of where all the exporting happens. So if we start to see the U.S. exporting, what does that tell you? Asia's starting to recover. They're going to recover before we do. Now, imports. Well, that's pretty simple. What does that mean? Cars, electronics, pretty much everything else, because we import a ton of stuff. So what does it tell you about the domestic economy when we're starting to import more goods and services? Well, it tells you two important things. One, we've eaten through the inventory level if we've had an inventory problem. And two, it tells you demand is coming back. So it's really critical. And it doesn't solve the world dollar liquidity problem, although you're going to love the chart I've got on that. But think about this. The solution to creating inflation long term and creating more dollars in the global economy is the world dollar liquidity cycle, right? We've talked about this tons of times. And if you're new to the channel, you're like, what's world dollar liquidity? Do a keyword search and you can find some videos. And we will talk about it again in the future, but I tagged it in all the videos. So just look up world dollar liquidity and you should find some videos I've talked about that. But imports suggest what? That world dollar liquidity is being restored. So this data is super important because if imports and exports, not just in the US, but around the world, around the globe, so here, globe, if imports and exports are shrinking, what it means? It means the global economy is shrinking. And if imports and exports are expanding, it means the global economy is expanding. It's the real deal. It's much better than retail sales and all that other data because you can't fake this. You can't seasonally adjust it. You can't go back and like, hey, well, we added some numbers up. Sorry about that. No, they can't do that. So let's go look at why I love this so much. All right, exports. Let's prove some thesis here. Hey, exports looks like after the dot-com bubble, bombed right at the end of the recession. And in the great financial crisis, they bottomed before the recession. So that would make sense that exports would start to recover first. How about imports? Now, you notice they haven't stopped going down. They have not stopped going down. Again, it's showing the May data. I don't know why the June data is. I did triple check on that. And it is updated as of today. So I don't know why the June data is not showing. But how about the import data? Let's test my thesis. Hey, imports recovered after the recession was over in the dot-com bubble. How about in the great financial crisis? Signaled the end of the recession. And so far, is this the end or is there more to come? It seems with what's going on, there is more to come. But let's continue forward. How does it relate to 10-year treasury yields? Look, did you really think for a minute that I was going to cover something and not related to treasury yields? No, of course. Of course. God. And look at this. Look at falling imports is bearish for treasury yields. It says yields should be coming down. So imports are coming down. Look, they kind of went down together. And they're kind of flattening here together. And so what happens when yields go down again? Does that suggest that imports are probably going down? Yep. Because look what happened over here. Yields bottom out. Imports started to bottom out. Treasury yields, so important in the macro world. How about against consumer prices? Some people are asking about that. I mean, look, we've got to look at this. This is important stuff. Here, let's look right here. Currently, consumer prices, red, headed lower, possibly headed negative soon. Look at imports, headed down. Look at the great financial crisis. Imports in blue went down. Consumer prices went negative. And notice how the consumer prices just massively exaggerated. So it tells us the consumer price index is likely headed negative. Tells us real yields are likely headed positive. Tells us some very important things that treasury bonds is super bullish. And that means possibly my view that gold goes down and I'm bearish on it is possibly right. And in my view that emerging markets go down, possibly right. And silver going down, possibly right. And Treasury inflation protected securities. So this is telling us this data is so important. And this is the May data. So what did the June data already tell us? They went down even more. Now, imports didn't go down as much, but exports aren't bottoming. Well, you decide. This isn't Steve tell you how to interpret macro. This is you seeing Steve's macro thesis, seeing what I think. Do you believe it? Do you disagree with it? What's your view? And hopefully you can form your own. How about corporate profits? Do they matter with imports? Yeah. I mean, think about it. I mean, look, all these companies export our jobs, right? That's how the world dollar liquidity cycle works. I'm a shoe company. I design in the U.S., manufacture somewhere else because it's so cheap. And then I import. And when I bring those shoes here to sell, now do I really pass that savings on to you? Nah. I'm still going to charge massively high prices. But the key is it's an import. So if I'm importing less to say as a shoe company, guess what? My profits probably going down. Where do you think maybe my stock price might go? Yeah, we'll see. We'll check that too. I got that chart. Don't worry, I got you. All right, so imports down during the dot-com bubble. Look, corporate profits went down. Shocking. Corporate bottom right around the time imports started to bottom. How about here? In the great financial crisis, imports went down. And where did corporate profits bottom? Right before. So it's again, right before imports bottom, corporate profits start to bottom. How about now? Corporate profits are headed lower. We haven't even gotten the next quarter data yet on this because imports are headed down. That means corporate profits are headed down. And what does that mean for stock prices? Well, stock prices head lower when imports and profits go down. So in the dot-com bubble, stocks didn't bottom until after imports bottom. And look at this. In the great financial crisis, they pretty much bottomed almost identically at the same time. Very close. Now, everyone thinks bullish for stocks. You know what this is called right now? Bag holders. People that are betting and are long stocks are going to find out in the next quarter earnings they're wrong. And the import data says you're still going to be wrong. Now, their view could be that stocks are a safe haven now, and that U.S. equities can be permanently overvalued and be held as a store of value. Now, I don't buy it because it's never happened, but maybe this is the first time in history that people will be willing to overpay and continually to overpay based on a corporation's profits. I doubt it's going to happen, but hey, could be the first time in history, and I will be admittedly wrong. I doubt I'll be wrong, but what this is telling you is stocks should be headed much lower because they follow imports lower. How about world dollar liquidity? You didn't think we could get out without talking about world dollar liquidity? Of course not. Is world dollar liquidity restored? No, not until imports bottom. Look at that. I mean, they're almost dead in sync. I know because it's overlaying the graphic. You can't see it that easily. I'll move the mouse off. So what does it tell us? That world all liquidity is not restored by any length of stretch of imagination because interest rates aren't low enough. So the Fed hasn't done enough QE, meaning imports are probably headed lower. But could QE do that? Yes, it can, because I overlaid that too. Here's the total balances maintained by the Fed. This is quantitative easing. And look right here. Imports crash right at, they started to fall and then the Fed goes brr with the QE engine and they crash imports. Like I said, QE is deflationary. There's more evidence. It crashed imports. And then finally, as QE, they turned off the first round of it, imports started to bottom and now interest rates were low enough and QE2 kept interest rates low enough so imports started to rise as consumers borrowed and started to spend and had demand. Look here, imports are falling. And they accelerated their move down right when the Fed blew their big QE back in March. And they're looking like they're starting to tail off as, the Fed's balance sheet starts to roll over. But don't worry, it's headed higher. It suggests to me that not only are imports headed lower, but corporate profits are headed lower, stock prices are headed lower, interest rates are headed lower, and bam, that, my friends, that is how you macro. And I intended to look at some charts today, but we're at our time limit. But I just wanted to see why I love this data so much. And when the June data gets this, we'll come back and take a look at it probably. I just want to show, anybody tells you the economy is recovering, this import and export data says no. I hope you enjoyed today's show. I hope you learned a lot. I'll see you tomorrow for a long Q&A. We'll be back Monday. Take a look at how hedge funds are positioned, see what's the market. We'll try to maybe catch up to these charts that I wanted to show you today. But thank you for staying tuned for my masterclass in imports and exports. I'm Steve Van Metre. Thanks for watching. Bye now. The content of this video is provided as educational information only. Is not intended to provide investment or other advice. Serial is not to be construed as a recommendation or solicitation to buy or sell any security, financial product, instrument, or to participate in a particular trading strategy. This video was prepared by Steven Van Metre. Personal capacity opinions expressed in this video that one do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.